This is not shocking. This was all by design from the beginning. They have inflated away essentially all of our purchasing power. So what happens when we go to zero? Well, in 2009, they started testing it and they were attacking your principal because there's no more purchasing power to get. Negative rates attack your principal. Once we are fully digital, what do the central bankers say? There are no limitations on how low we can go. I think it's really interesting because what happens when you lose all confidence in the currency, when the purchasing power goes to zero, can I have my graph back, please? Then you get hyperinflation. That's when the public loses all confidence in the currency. Gold is the only proven inflation fighter, the only one. Any of the new currencies, the cryptocurrencies, they came out in 2009. They have not been tested yet. Gold's been around for thousands and thousands of years. But let me just make this a little bit more clear. You go to the grocery store, don't you? You go maybe once a week, maybe more. And what are you seeing? You're seeing the prices go up and up and up. There was a day when I first got divorced and I was taking care of my babies and I had $20 to go to the grocery store. $20, that was it. And I had to make that $20 last as long as I could. And I could feed my children on that. Today, if you have $20 to go to the grocery store, you're buying nothing. Absolutely nothing. This is a result of central bank managed inflation. Do you really want them managing the new system as well? Whose benefit do you think they do anything in? Not yours or mine. This is why we have to come together in community and have a voice. If we don't do that, what are we going to get? We're going to get more of the same, and then we are enslaved. We become debt slaves. We have to come together and say no. And how do you do it? Just a quiet revolution. You just convert your fiat money into gold and silver. This is not rocket science. It's really simple, and it's been proven over thousands and thousands of years. After the Federal Reserve was put in place, they could now print $2.4 for every 20th of an ounce of gold held in deep storage. And looking at the graph, you can see how it lost about 50% of its value, of its purchasing power value. Is this a surprise? Not really. And then after they did all of that confiscation, do you ever remember hearing anybody say how great the Depression was? How their purchasing power just exploded during that? We saw, I'm not going to talk about that today, but we saw very similar action to this in 2008 when prices were rising really rapidly. Because what they did is they gathered all the gold they could, and then they did a gold revaluation. By the way, every country has a gold revaluation account.
Lynette Zang delivers a compelling analysis of the current economic environment, focusing on the erosion of purchasing power and the critical role of gold and silver in preserving wealth. She highlights the deliberate inflationary policies that have systematically devalued fiat currencies, leading to a situation where the real value of money is approaching zero. In 2009, central banks began testing negative interest rates, which directly attack the principle of savings. As Zhang points out, once we are fully digital, there will be no limitations on how low these rates can go. The implications of losing confidence in fiat currencies are severe, leading to hyperinflation and economic instability. Gold, however, stands as a proven inflation fighter, retaining its value through thousands of years of economic upheavals. When hyperinflation hits, the public loses confidence in the currency and prices skyrocket. This scenario has played out in various countries throughout history, from the Weimar Republic to modern-day Venezuela. In these situations, gold has always been a reliable store of value. Cryptocurrencies, while innovative, lack the historical track record of gold and have yet to be tested in a major economic crisis. Zhang illustrates this point with a personal anecdote. When I first got divorced, I had $20 to go to the grocery store to feed my children. Today, that same $20 buys almost nothing. This stark example underscores the impact of inflation on everyday life and the necessity of holding assets that preserve purchasing power. Central banks have managed inflation to benefit themselves and large corporations, not the average consumer. They print money, devaluing the currency, and create an illusion of prosperity through rising stock markets. However, this illusion hides the underlying economic fragility. Zang urges viewers to take action by converting fiat money into physical gold and silver. These metals are not just investments, they are essential tools for financial survival. The Federal Reserve's ability to print 2.4 for every 20th of an ounce of gold held in storage shows the immense devaluation of fiat currencies over time. Historical context is crucial to understanding gold's value. In 1933, during the Great Depression, the U.S. government confiscated gold from its citizens and then revalued it, significantly increasing its price. This move preserved the government's wealth at the expense of individual citizens. Today, every country has a gold revaluation account, ready to use gold to restore confidence in their currencies if needed. Zang recounts the events leading up to the U.S. leaving the gold standard in 1971. Before this move, the dollar was backed by gold, providing stability and confidence. When President Nixon closed the gold window, the dollar's value plummeted. Since then, central banks have used interest rate manipulation and globalization to control inflation, but these tools are losing their effectiveness. According to the Federal Reserve, the purchasing power of the dollar has declined from $1 in 1913 to just 3 cents today. This dramatic decrease highlights the need for assets that retain value. Zang points out that 100% of government-backed, debt-based currencies eventually go to zero. The only thing maintaining their value is public confidence, which is rapidly eroding. Inflation creates nominal confusion, where the face value of money appears stable, but its purchasing power declines. Zang uses the example of average wages. In 1971, the average wage was $1,290, and an ounce of gold was $35. Today, the average wage is $63,750, but it requires 2 wage earners to support a family, compared to just 1 in 1971. This discrepancy shows that while nominal wages have increased, real purchasing power has not. If workers were paid in gold rather than fiat currency, their purchasing power would be significantly higher. For instance, if wages were paid in ounces of gold at today's prices, the average worker would earn $698,000, reflecting gold's ability to retain value over time. This example highlights the importance of holding gold as a hedge against inflation and currency devaluation. The deliberate inflationary policies of central banks have eroded the purchasing power of fiat currencies. This trend is not new. It has happened repeatedly throughout history. Gold and silver offer a proven means of preserving wealth and protecting against economic instability. By converting fiat money into physical gold and silver, individuals can safeguard their financial futures. Understanding the historical context and current economic realities is crucial for making informed decisions and ensuring long-term financial security.
So, when the citizens lost that convertibility, bringing in their dollars, bringing this into the bank and walking out with this, okay? So in 33, citizens lost that convertibility. We were at 79 cents worth of purchasing power out of the original dollar. Now, 8171, okay? So that was just before Nixon took us off the gold standard. There was a run on the dollar in the 60s, which forced him to go ahead and close that gold window. What he really did was reneged and defaulted on the system that was set up in the 40s through Bretton Woods. But even at that point, we had almost 26 cents on the dollar, and countries lost that convertibility. Now we are completely in a debt-based system controlled by the central bank's ability to raise and lower rates to control the rate and speed of inflation. This was the first time that was actually tried historically. So you can see that we had a pretty rapid downward move in purchasing power, and then it sort of seemed to level off. So doesn't seem all that bad. But now officially, according to the Federal Reserve, out of the original $1.02 worth of purchasing power, we have 3 cents worth of purchasing power. And let's just go a little bit deeper to this because we can see this clearly on our march to zero. But from 1971, that's what I want to talk about, central banks have used that interest rate and globalization, right? Going to other countries where their labor is a lot cheaper to create deflation to control inflation. How nice. All right, here we are. I'm going to go through this pretty quickly because I think so much of it is self-explanatory. And you can see that we still have the lovely zero on the Federal Reserve chart because 100% of the time, government-backed debt-based currencies go to zero. 100% of the time. And you can see that we are pretty darn close. And the only thing that's really holding it is the confidence. But I want to point out to you that what inflation does is it creates nominal confusion, right? And this is a great example of that. 1971, from the BLS, Bureau of Labor Statistics, the average wage was $10,290, and spot gold was fixed at $35 an ounce. So if you had just been paid in ounces of gold, you would have ended up with 294 ounces of gold. And you can see that at $35 an ounce, that equates back to the average wage. Now we're off the gold standard. This I just pulled on the 10th. And at that point, the average wage was $63,795. Wow. Wouldn't every single one of you say, I would much rather have $63,795 than $10,290? Except a family of 4 could live with 1 wage earner back in 1971. And now you need 2 wage earners. And guess what? They still gave money to anybody earning under $250,000. So what does that tell you? Well, guess what? Hold the fiat currency raises, right? Just pay me in the same exact number of ounces of gold that I would have been paid for in 1971. And at that spot price on the 10th, that means just at spot that I would have been paid $698,250.
Central banks worldwide are accumulating gold at unprecedented levels, recognizing its enduring value and role in ensuring economic stability. For example, countries like China and Russia have significantly increased their gold reserves in recent years. This trend reflects a growing recognition that gold is a critical asset for economic security and sovereignty. China's aggressive accumulation of gold is part of a broader strategy to reduce its dependence on the US dollar and increase its economic influence. Similarly, Russia has been diversifying its reserves away from the dollar and into gold to protect against economic sanctions and currency volatility. These actions underscore the strategic importance of gold in maintaining national economic stability. While gold often takes the spotlight, silver also plays a crucial role in a diversified portfolio. Silver has historically maintained a close price relationship with gold and offers significant industrial applications, which can drive demand and value. Its lower price point makes it accessible for smaller investors and provides additional diversification benefits. Silver's dual role as both an industrial and monetary metal makes it a unique investment. During economic booms, industrial demand can drive prices up, while in times of economic uncertainty, its monetary value provides a hedge against inflation. This versatility makes silver a valuable addition to any investment strategy. Practical steps for investors. For individual investors, diversifying portfolios with physical gold and silver is a prudent strategy. This involves purchasing coins and bars and considering gold-backed investment vehicles and digital currencies. Staying informed about global economic trends and policy changes helps in making informed decisions and adapting investment strategies as needed. Regularly reviewing and adjusting portfolios ensures alignment with long-term financial goals. This proactive approach enables investors to navigate economic shifts and protect their wealth. Holding physical gold and silver provides a hedge against economic downturns and inflation, ensuring financial stability. The concept of gold-backed digital currencies represents a significant innovation in the financial world. These digital tokens, backed by physical gold, offer a way to stabilize economies plagued by hyperinflation and currency devaluation. However, ensuring these tokens can be converted into physical gold is crucial for realizing their potential. Investors often have concerns about storing and liquidating physical gold and silver. There are various secure storage options, including home safes and professional storage facilities. Ensuring the safety of these investments is crucial for preserving wealth. Liquidity is another common concern. While gold and silver are not as liquid as fiat currencies, they can be easily converted into cash when needed. Numerous dealers and platforms facilitate transactions, ensuring that investors can access their funds when required. Economic shifts are inevitable, and being prepared is essential. Holding physical gold and silver provides a hedge against economic downturns and inflation. These metals offer stability and security, ensuring that wealth is preserved regardless of economic conditions. Building a comprehensive financial plan involves not only investing in gold and silver, but also ensuring access to essential resources like food, water, and energy. Building a community and fostering self-sufficiency are critical components of this strategy. In conclusion, strategic financial planning with physical gold and silver is essential for protecting wealth in today's volatile economic landscape. These metals provide stability and security, ensuring that wealth is preserved regardless of economic conditions. By understanding the broader economic context and taking proactive steps, individuals can safeguard their financial futures. Investing in gold and silver is not just about short-term gains, but long-term security. These metals have a history of preserving wealth over centuries, making them reliable investments for future generations. By staying informed, diversifying portfolios, and preparing for economic shifts, individuals can position themselves to thrive in a rapidly changing world. For American and allied citizens, recognizing the strategic importance of gold and silver in preserving national economic security is crucial. As global economic dynamics shift and fiat currencies face increasing pressure, these precious metals provide a reliable foundation for wealth preservation. By investing in gold and silver, you not only protect your financial future, but also contribute to the broader goal of economic stability and resilience. Stay informed, take proactive steps, and ensure that your investment strategy includes these timeless assets. In a world of uncertainty, gold and silver offer a beacon of stability and security.
Stay informed about the latest developments shaping the precious metals market with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today. Link in the description.